most important FOMC of 2026. We're kicking it off here in January with our first FOMC, and so of course it's going to be the biggest. It's going to be the most critical. It's going to set the stage for the rest of the year. It is the third to last FOMC with the GOAT himself, Chair Powell. In May, he'll be replaced by Trump with somebody. The verdict's not out yet. That may not have a big impact, or at least as big of an impact as people expect. The FOMC is a voting board. There's 13 votes. Powell is only one of them, and so as much as we like to blame him for everything, he's only worthy of 1/13 of the vote. But we are going to have major mix-ups there in May, and so these are really going to set the stage. There's going to be a decent amount to be watching for today. On my radar, quantitative easing, quantitative tightening, going to be the most important possible thing that Powell could comment on. Interest rate decisions, we are always hopeful that we'll get interest rate cuts, but something tells me that's not in the cards today. We're going to look at Fed monitoring tools. We're going to look at some other stuff before this kicks off. But in my opinion, we are not going to get an interest rate cut, and probably not going to get an interest rate cut until Powell is no longer chair. I think that at this point, Powell believes he has defended his legacy as chair effectively. I would agree. He's done I would say the best possible job he could have done in the scenarios he's been in. Obviously, it wasn't perfect. Obviously, in hindsight, things could have been better. But I believe in real time, he's done a great job of balancing unemployment and inflation. He's kept them in check. And he is unlikely to ruin or spoil his 8 years of chairmanship in the last quarter here. I think he's going to defend it. He's not going to care too much if we see assets sell off or close down into the end of his chairmanship. That's not what he's about. It's not his prerogative. Let's do it this way. We are the home of the FOMC live stream. We invented it right here. You and me and all these people together. We created this. We may have turned Powell into a world-class celebrity. It's possible. We've done it together, and I appreciate you tuning in here. Since we started covering these years ago, every mainstream media news channel, every trading, every economics channel, all covers it live, so I know you have a choice, and I appreciate you being here. You guys are the OGs. Wouldn't spend it any other way. I lost my notes. I had this whole notes thing, but anyway, I'm going to just wing it. Appreciate you joining. Make sure you subscribe during the live stream. Hit the like button, put a vote in the poll, put a message in the chat, help hype up the algorithm, whether you're over on X or on YouTube. Just engage. Have a good time. These meetings are usually very bland and dry and not exciting or fun, and we're going to try, as we always do, to make them fun. And we're going to do that together with community. I'm going to be a goofball. You guys are going to be a goofball. Can I get a Chair Powell in chat? A little Chair Powell, a little chirpy. We're not going to have many Chair Powells left, guys. It's the sad fact of it. We're running out of Chair Powells. My only hope is whoever replaces him also has a really memeable name. That's all. That's my biggest hope. It's like, it's got to be something that I can chirp into, you know? We're going to give away some memberships here while we warm up. The schedule is in front of us. I have Bitcoin, gold. We may replace this with silver. We'll see. And the dollar, the Dixie down here on the chart. We're going to be watching these in real time as these events unfold, and we're going to be watching the price action. I typically advise everyone to be cautious trading today. I don't like to open positions into this. Even I typically like to close positions into the FOMC. We see very high volatility, but that high volatility tends to be destructive, especially on leverage. Very commonly, we will see price whip in both directions. I call this the FOMC trading blueprint, and we typically see this play out. So into the interest rate decision, which is 23 minutes away. We typically see price trend in a direction. So for now, let's just call it down. Basically stopping out longs, baiting in shorts. After the interest rate decision, we tend to see that reverse as Powell speaks. And then as he speaks, it tends to just kind of move back to where it was. And this results in longs and shorts both getting stopped out or liquidated. And it just is not a great environment to trade. So just be cautious. Obviously, you guys do whatever you want to do, but I got to warn you so I can sleep well at night. Up on the chart here, we have 3 lines. You will see this was the start of the stream. We don't really need this one anymore. At 2 p.m., when the candles reach over to the rate decision, we will have the rate decision published live. Slightly before that, we'll get our browsers open and we'll try to Google that up to be the first source to get that information. And then at 2:30, Powell will speak live. I'm still waiting for the Fed to actually put a live stream up. There we go. They finally did. Wow, that took them a while. Usually this is up really early. For some reason, they just got it up. At 2:30, he'll speak, and we're gonna try to dissect it together. Like I said, the biggest things he's likely to talk about is the economy, inflation, unemployment, maybe the numbers we got from October, though I didn't review those so well. We are coming off the back of consecutive cuts, so he may weigh in on how those cuts have played out, have it gone according to plan or no. We'll get an update on the dot plot. The dot plot is a big banger. We love the dot plot here. Hype it up for the dot plot. The dot plot is the best plot, honestly. Mostly because it's a chart that the Fed puts out. Let me see if I can grab the most recent dot plot. I should have pulled this up before. Good enough. This one's from, when's this from? We'll pull it up later. I want to Google it in real time. The dot plot is basically where each member voted and where they see the Fed rate into the end of this year, next year, 2018, and the long run. That gives us probably the best information. Honestly, that's the best source. That's why we love the dot plot. We'll get forward guidance through Powell's speech. The words he uses, the tie color he chooses, everything he does is important. And that can give us clues, contextual clues as to what we can expect into the next few months. He may, this is possible, even comment on the end of his chairmanship. To the Powell haters out there, I will burst your bubble here. Even though he is very unlikely, that would be the craziest. Wouldn't that be the craziest outcome if Trump, after all this, just reappoints him? That would be the craziest outcome. Now I want to bet on that. Poly market, let's go. Kalashi, let's get those going. Even when he is removed from the chairmanship, he still will be on the board of the Fed. I don't see him stepping down from that, honestly. I think it'll be important to him to remain on, and that goes into 2028. So Powell will be here either way, but he will not be the FOMC speaker most likely. You know, it's really sad. We've lost Gina, and now we're going to lose Powell. Rough times, bear market times for these FOMCs. Let me see. What did I miss here? The Fed's recent restart of Treasury bill purchases or quantitative easing. Yes, we're going to be updating on that, looking for that. We can see this reflected through, watch your screens, the Fed balance sheet. As the Fed balance sheet moves down, that's quantitative tightening. So you can see quantitative easing came to an end in 2022. We began the quantitative tightening cycle. And now, as of December of last year, just 1 month away, right here, we can see that cycle coming to an end. The Fed said that they were going to halt quantitative tightening or balance sheet sell-offs, and basically we saw a tiny reversal of this. We haven't seen a full-fledged run here, but that's the start. We're going to see that really over this year come into its wings as these maturity dates on some of their assets and things expire, etc. So we're going to be watching for this to move up. You can see the last time we were in a quantitative easing cycle was all the way back here at the start of 2020. And that was obviously, that actually happened before the whole COVID thing. That's interesting. You can see the balance sheet expanded starting in February. February, March is right around COVID. So that worked. That's what we're going to be hoping for our moon bags to be pumped. We'll see. The Fed rates cut, like I said, we were coming off of multiple cuts consecutively, or at least multiple in the last few months. Here's the history of the federal funds rate. You can see while they are elevated right now, and people are upset about it, in the mean of the last 75 years, they're actually rather low. It was only in 2008 2008, really up until that 2022 era where we had these very low federal funds rates. The rest of the time we've seen rates as high as 17, 18%. Pretty wild. That is coming back down now slowly as these cuts come in, but I think that we're going to see a pause, as I said, into the first quarter here. Unlikely to see much change up on those rates until Powell is out. What did I miss? What did I miss, fam? What do you think, guys? What do you think? I know I missed Gina. And then Asian Gina like baited us. We got rage baited on that. She came and went. We got, let me make sure all these alerts went out. Make sure I posted. That's stupid. This post must have 500 characters. How many characters does it have? That's so silly that I'm just going to put a bunch of exclamation points. It's okay. It'll get taken down anyway. There we go. Ed Flair, I'm such a they're going to ban me. They're going to ban me. It's okay, Reddit. You're an angry place, Reddit. All right, let me close this. Pulling up the chat. We got quite a few live viewers here. Who's here today, boys? How's everybody doing? Are we feeling the FOMC? Isn't it crazy that it's 2026? Like, 2026 just started. I already feel like it's been forever. What's up, Paul? How you doing, man? Dinkles, Jasper, Chris Pax is here. How you doing? Optical Art, my guy, Steve. Came and went. She's knocked up. No, she's not. She's definitely not. I don't think she's knocked up, my friend. She's married to a woman. I might have to look into that. Monkey says, surprise 500 BPS cut today. Let's go. What's up, God? Pickle, OBSY, NY Weather Girl. How you doing? Welcome. D-Lo Brown. Who else is here? Put a message in the chat. BPN, Dark Side, Das Peach, my friend. David B, Dimitri. I thought it was a good idea. Jordan, Bitcoin, Kirby Crypto, Larry, Not Quicker. What's up, Quicker? How you doing, Brad? Good to see you catching the stream. This one's a little later. Orlando, Quarter Crawl, Ronald Grump, my guy. Randy, RPM, Saint Airway, Trinity, Loons, Balloons, Verhoofdy Floofen, Orlando. We got a whole crew. The whole crew here today. It's good stuff. Let me see some of my little notes here. What's up, Eric? How you doing, bro? What happens if they cut? What happens to metals? That's a good question. That's a good question. Right now, I think metals are so hot that it likely wouldn't have like a meaningful impact, in my opinion. I think with the pause, we are likely to see some strength in the dollar. The dollar broke down. You can see silver chilling here. The dollar broke down yesterday and into the FOMC. We're seeing a little recovery here. I wouldn't be surprised, even if it's just a dead cat bounce, to see the dollar regain a little bit of its loss, and that likely reflecting or putting downward pressure on metals, but also downward pressure just on everything. You know, metals have been running so hot. I don't think it would be like potentially an end of this run. It doesn't add up to me. Daddy. So what's up, brother? You guys follow Optical Art. Follow Optical Art and Chris Pax, great YouTubers here in the chat. What's up, bro, man? For the day, sit it out. Good idea. Better to feel the FOMC than FOMO. True. You know, that's a reason that we like to do this too. Is like it gives us something to do during it. Fight the itch to open a stupid position. What's up from Mogadishu? I don't know where that is, but what's up, Mogadishu? Our room start a rap battle with Trump. I think I'm down for that. What's up, Johnny? Hit the like, yes. Hit the like, subscribe, join. There's still time before the excitement starts. What's up, CRJE, the Blob, 420 Blaze, boys. What's up? Life feels really long in crypto. Yeah, it does. The last 3 years have felt like a lifetime. A freaking lifetime. What's up, Trance? Got some new names. Welcome, friends. Let me see some notes here. We have 15 minutes until the interest rate decision is in. Already seeing Bitcoin do nothing as is probably the best bet. Gold trading down a little bit. Really just the dollar so far. Seeing any kind of upside into the interest rate decision. But again, volatility is coming. There's just no way around it. Volatility is about to knock on the door here. Silver even down a little bit. Important context: the last vote, the last cut brought the interest rate down to 3.5 to 7.5. 3.75. We can see the Fed rate tool, probability, whatever. On investing.com, this has been pretty accurate. Sits at 99% chance of no cut, of no change. Kind of curious. I don't like, I'm not shilling. I don't want to shill these platforms. But what do we have on the prediction markets? I'm kind of curious here. Curious where the money is. Fed decision in January here for Polymarket, 99.6% no change. Honestly, that is more accurate than the 98 that we saw on the other one. Let me see if Kalashi's got anything. 99%. So we see all the prediction markets at 99%, the estimations at 99%. They're on point. The Tom Crown indicator agrees with them. Here in January with woo. Hopefully that hasn't been playing the whole time. Little echo. The last cut was a divided 9-3 vote. Not that divided, but a little divided 9-3 vote where one person pushed for 50 BPS cut and 2 pushed for no cut. So the board pretty in line. They usually are more in line than that, but it does highlight a potential growing splitting of thought, of agreement in the board. Nah, that's maybe a little sensational. Slowing consumer demand and normalizing labor market. Our dot plot projected 125 cut for all of 2026. There's the banger. There is the important context here is the dot plot only is forecasting 1 cut for this entire year. Entire year. Last year they had slated, I think it was like 5 cuts. It ended up being 3 or 4 or something. The Fed is the one thing the Fed is good at is looking long and planning out and saying, this is what we're going to do. They do adjust it in real time, but like they are pretty damn good at that, considering how crazy, how many variables they're tracking, how much goes on in the world. They have had a pretty solid history at that. 1 cut all of this year. I think that that's probably not as FUD sounding or as painful as that might have, if we heard that last year, felt. People were really overzealous about these cuts. Every single month we heard 100 BPS cuts coming and Powell stepping down. This year, I feel like maybe that's not as rough to digest because we've had cuts come and go and really nothing has happened. The cuts have not had an impact on crypto. The cuts have, I would argue, really not had an impact on the stock market. Stocks just, in an upward trajectory still. Throughout these cuts, highly unresponsive, just kind of in trend. Metals, it would be an interesting study to go back and look at metals' reaction to these cuts, but I don't have time right now. I have a feeling not that big. So these cuts were just largely anticipated. Oh, hi, guy over here. Who's this guy? I don't know. Highly anticipated, but they were largely nothing burgers. Quantitative easing is likely that magical switch that we're all hoping for. We're all hoping that will moon our bags. That cut, I'm going to say it. I called the cuts last year. I'm going to call it again this year. That cut, September. If we have the 25 cut 1 this year, September. That is obviously not calculating in potentially whatever could happen after Powell is no longer the chair. Who knows? If there's some kind of wild card mix up there, that could be different. What about the Zow? Gold is pumping, bro. Gold hit an all-time high again today. Gold's actually moving kind of relatively slow. It's hard to say that as these beautiful green candles keep printing. Still fast for gold. I want to say fast for gold. Friday, we closed at what? Right? 5,000? This is so ridiculous saying that's slow. I'm laughing at myself. Friday we closed at, here we go, 5,000. Here we are at 5,300. So $300 move sounds huge. It's a 5-6% move. For gold, that's crazy. Yeah, we're just getting spoiled here as gold is climbing so quickly. Silver's climbing so quickly. But it is continuing its upward trajectory where silver has actually what? Just hit its high Monday and hasn't recovered quite yet. Sunday traded up to 117, sold off. I mean, this is still looking strong to me. Unless silver trades below 103 now, I think it's still continuing. But we have seen metals take a little chill here, and I think that's expectation of Dixie strength. Of Dixie strength. That's what she said. I think the pause on rate cuts, we're going to be looking at potentially a little bit more hawkish, a little bit more conservative Q1 for this year. And I think we're going to see a little bit of strength when it comes to dollar for that. That's likely not going to energize metals, but maybe not necessarily stop metals in their tracks either. Peter Schiff is goated. I mean, he certainly is now. He was the opposite of goated for 15 years. It's interesting how markets come and go like that. Someone can be so wrong, right? Because nobody is like really. Usually, we're not. No one's really long term wrong because eventually everything happens, and then all of a sudden, gold, silver, all these metals just start running, and now he's like a genius, right? Uranium trading above 7,700 here. New all-time highs today on uranium. Looking for what? The next upside target, the measured move. 8,785 uranium on a ripper. We have 7 minutes, by the way, till the interest rate decision is in. So prepare your tabs. Start your Googling tabs up. We're going to be looking for the first source to publish the change. When it comes out, please put it in chat. Whoever does it first wins great honor. But make sure to include a source. Don't just put a number. Don't just put no cut with no source. We need a source, and that source must be published after 2 p.m. today. Those are the rules. Uranium ripping. What else is that on? Silver. We just looked at silver. Platinum. Taking a breather, actually. Interesting. Platinum, I expect to be highly bullish into the end of this year. Gold, silver. This is what I was looking for. So the gold silver pair. This is interesting. Hit a major trend line. And since it's hit that trend line, silver has kind of paused and gold has continued upwards. A support trend line from the 80s into 2011 put the gold silver ratio exactly at its low this week. And that was when silver was at its all-time high. That has not broken since. And gold has continued upwards. Interesting that this trend line is still in play. And still predicting at least gold catching up a little bit with silver in the short term. TBD. Okay. 5 minutes. 5 minutes. Count them. What is going on over here? The Fed is... Are they running commercials up here? For the Federal Reserve education. Equipping educators. Educating students. They should get me on here. I should be on the board of the free. I want to empower consumers. I want to teach students. Free.org. All right. I've never heard of that. How many they got? 5,000 watching the Fed. 5,000. How do you trade the FOMC 𝐒𝐈𝐆𝐍? I highly recommend you don't. That is, all the years we've done this, I've recommended the same thing. It's not a great idea. It's highly volatile, especially it depends on what you're looking for, right? For Bitcoin, I can comment, highly volatile, typically a similar pattern that just leaves everyone wrecked. I think it is honestly better to just wait it out. I think there are more trades coming in the week, more trades coming in the month. I don't trade it. I don't think it's a great idea. Board of the free land of the Bree. What's up, Papa Chuck? What's up, Zen Motion Bitcoin Market? What's up? How to trade the FOMC short as soon as he talks. That probably has like a 50% hit rate. Really, what it is, the best way I can describe it is at 2 p.m. look for reversal, and at 2:30 look for reversal, and then by 3:30 p.m. that day, typically you're right just back to where you were, so like 89.5. That is my best, easiest overall explanation of how you could theoretically trade it. Reversal at 2, reversal at 2:30. Easy. Natural gas is up. Yeah, we've been watching Nat Gas. Nat is this month at all-time highs. I don't have time to really go into it. Little pullback here. These are tiny little candles. I have to reset my alert. But there's no time. There's no time, boys and girls. We have 2 minutes. May not even be 2 minutes. My computer clock is, for some reason, always wrong. Set time automatically. Yeah, I got like 2.5 minutes. until the interest rate decision is in. That means we have 32 minutes until Chair Powell speaks live. Greatest time as ever. Get your tabs up. Get ready to get this into the chat. Let's go. As we're doing this, though, make sure you're hitting the like button. Please like, subscribe, share out the stream. Let's get it hyped. Let's give people a home to watch this. That's what we are. I appreciate Life with Chigor subscribed, Simon Champs, NC Production, TJ Vasquez, many others. Many others subscribed during the live. I'll try to shout you out. I don't know how I'm up here. I'll try to shout you out. But if you do subscribe while we're live, your name should pop up here. It's very exciting. Very nice. So join us, the home of the FOMC. I have CryptoCraft pulled up for mine. CryptoCraft is a free site. Covers crypto news, has like a crypto economy calendar. You should sponsor me, CryptoCraft, because I'm always shilling you for free. I'm going to use this. We see 1 minute, 30 seconds coming on in. Coming on in. We're going to get this interest rate decision. Lurker alert. Yeah, if you're out there lurking, say hello. Hit the like button. Oil correlated with inflation. Oil is maybe the biggest driver of inflation in the U.S. Like, maybe not even the word driver, but like the biggest factor. Like, energy is the core cost of everything. When the cost of energy goes up, inflation is inevitable. And when energy goes down, inflation cools, right? Because the base cost of everything. So, of course, it is highly correlated. Of course. Gold's right here. A little green coming on in. We can see even Bitcoin, the 2 o'clock reversal may be coming in right now, right here. What's up, Rick G? Smash the likes. I appreciate you, brother. Thank you. What's up, Folsom Hodl? Line in my pocket. Ethereum down to 3,100. We can zoom in and check out some other charts here. But right now, we're waiting. 28 seconds until the interest rate decision is in. TikTok. Be the first one to put it in the chat. What's up, my guys over here subscribing? We do everything. Barack Enzo FF. What's up, bros? You found the right place. Lock it in. Lock it in. 10 seconds, boys. Higher energy costs affects Bitcoin mining? Yes. Higher energy costs affects the price of everything. The cost of everything, maybe not the price. Am I going on strike this Friday? I don't know. All right, here we go. Interest rate decision is in. Put it in the chat. Been watching since COVID. Funny colors. Let's go, bro. The golden era of streaming. No cut. We need it. We need a source, Trinity. 0%. We need a source. Where's your source? Here we go. The source of CryptoCraft says no cut. No change. No change. I need sources, though, boys. I need sources. Forex Factory, no cut. They've been a good source historically. No cut. There it is. Everyone on Polymarket 1. Everyone on Kalashi 1. Everyone betting on the Fed Monitor Tool 1. Let's check out what's happening right now off of this no cut. And remember, markets largely expected this. This is not a surprise. So, no mix-up spice. Here we go. Dollar moving down for some reason on no cut, an expected no cut, sure. Bitcoin taking a little bit of a green here, basically looking at that 2 p.m. reversal. Gold, a little bit of upside here. We're talking fractions of percents. Silver, same thing. I'm going to get rid of silver. We don't need this right now. There we go. Looks like assets with a little bit of green. Now dollar with a little bit of green. This is very unspicy. The last few FOMCs, we've seen explosive moves off of these candles at 2. This is very mild. Extremely mild for this. To be fair, nothing actually happened. So, yeah, but what would be unmild about it? Stocks green, already retracing that green. Likely we're going to see, yep, here we go. Markets finally acting the way that would make sense. It's a rarity here in 2026. The dollar with a nice green candle, giving us a little bit of spice, saying, Tom Crown, why are you being so bearish on the spice here? We've got a 0.2% on the Dixie. Gold reaching the lows of the last hour. Bitcoin reaching down as well. Gold looking potentially to break that low of this morning. The dollar pumping. Let's zoom in on the dollar here while we have a minute. Wow. The dollar is the hardest thing to chart, I swear to God. The dollar broke its huge trend line. We looked at this earlier. And potentially here on this FOMC news, looking for a short-term bounce. This is pretty much what we discussed on the streams recently. putting the brakes on the metal rally, at least temporarily. Where are we? Right back to the trend lines. Crazy spicy. A little bit higher, and we will retrace all of yesterday's losses on the dollar. Stop here and look out below. Like Geronimo, look out below if you stop here. That's wild. Right back to the trend. I'm going to set an alert just a little bit higher because that will be meaningful if it breaks it. I didn't even look at platinum. Platinum's right here. Right. What do we got? Silver chilling. Not used to wearing the glasses anymore. I've had them off for so long. Gold not loving. No change. Silver not loving, no change. Yeah, it makes sense. A little strength on the dollar. You expect downward pressure on assets. That is how pairs work. Beautiful little candles coming in. All right, we have half an hour or less until Powell speaks. What do we have time for, boys? Bitcoin hits 86K by the end of the day. Prediction, 86. Where are we at? 86? That could happen. Yeah, we're at 89, 86. That's not too far. What's up, Nomadic Pam? How you doing? Quinn? The glasses are back, Quinn. Yeah, they're an FOMC special, right? Gotta have them on. Gotta have them on for the FOMC. What's up, CBK? Money from gold sell-off going into the dollar. Yeah. Save your dollars. So one kind of confusing element, and I'll admit, like, even as someone who follows charts and markets all the time, still is hard to conceptualize this. The Dixie, you don't necessarily, like, you don't have to have like a sell-off or a rotation into the Dixie, because the Dixie is the basket of currencies, right? It's reflective of how the euro, how the yen, how the Swiss franc, how the British pound, how strong they are in relation to the dollar. So you don't need or necessarily look for like a rotation of like gold selling into the dollar. You could say that, but I think what would make more sense in looking at the dollar would then to just be look at gold USD. If gold USD goes down, that's what's happening. When Dixie itself moves, it's a reflection of its strength versus those other currencies. So it's just confusing. It's confusing. It's logical to think of the Dixie that way, like you described, but it isn't exactly how it works, right? Gold, I keep saying Bitcoin. I'm so used to saying Bitcoin all the time. Gold USD would be more reflective of that. The Dixie would be more reflective of what's going on with, like, say, the euro. I think the euro was crushing the dollar this week. So we're seeing the dollar gain some strength against the basket of currencies, which makes sense. There is the hawkish fiscal policy, not looking for more cuts, while other people might be cutting, etc. It was expected and priced in, of course. Of course it was. Only a fool thought that we're getting an interest rate cut this month. Even last month or even the months before. You have to be pretty foolish, I think, to expect that. 50% year? What's going on with the year? The year? I should have watched the Euro Bitcoin pairs and like the GBP Bitcoin pairs, because with their strength, we might have seen them break low before the USD pair. Let's check this out. Euro USD. Okay. Real tall wick this week. Coming back down. Still below 2021's high. 0.23. That looks pretty decent though. Higher low, higher high. Our size nice up. When you invert this looks pretty. You know what this looks like when you well, of course. When you invert it, of course it looks like this. The Dixie. The run up. This is the run up, the years of consolidation. Lower high breakdown. Looks like the Dixie. That makes sense. Silver hanging out sideways. Dixie chilling. All right, here we are. Coiling up, price action in anticipation now for Powell. Not a huge mix-up on the no cut, no interest rate change decision. This was largely, like you guys have said out there, largely priced in, expected by markets. There was no reason to think there'd be a huge explosion or dump based on that. You love the beard? Alessandra Leonardo. Thank you. I grew it myself. It's real. It's not fake. It's not an implant. What's up, Jay Peters? Welcome, brother. This is Brick. What's up, Ed? My guy, you're here. Ed, you've joined us. Rate decision was no change. That is correct. Powell will speak in about 20 minutes here. No change. Gold will fall, says Fat. What is, I'd love to hear your thesis. My thesis would be gold. Gold went on maybe the craziest ripper it's ever gone on. Gold actually just hit the 2618 extension, which is kind of spicy. Big talk this week. We've been talking a lot about metals. Obviously, why not? Why wouldn't we? What are we talking about if not metals? One of my biggest complaints, or maybe cautions about gold, was we simply don't have anything to go on. Gold making its move from 4,500 all the way up to like 5,000 and change. We don't have a chart to work with. We're in price discovery. There's no resistance above. It's never traded there. There's no levels to look at. Typically, we use our fib tool, and our fib tool guided us to the $5,000 target, but now we're kind of out of fibs. Right here's the 2618. That sits at 5,315. That's, it's valid. We can use that. But we can always just keep adding 3, 3, 6, 1, 8, 4. I don't think that is really a great way to do it. But with a complete lack of anything else to go on, here we are at the 2618. If there's no pullback here, let's say like 5,000, that could be a good entry. I guess we just continue to look up 555 to the 3. We're out of tools. We can say psychological numbers. We can say 7,500. We can say 10,000, of course. We could look all the way back to 2011 to 2005. Measure move up here, the 3. Measure move, no, the 3 extension. It's hard. It's hard to chart when you don't have any history to go on. We go all the way back to 1980 to 2001 and use the 3, and that's a 10K. Makes sense. But we're running out of room, running out of tools here. So the 2618, I guess, is where we're at this point. Gold has an untested resistance broken at 4,500. While it's in this parabolic state, I don't think we get a clean back test of it and run. I think at most we'd be looking for like 5,000 if we're going to continue to see this parabolic move. As soon as this starts behaving like TA's supposed to, like breaking resistance, backtesting as support, that's likely when the parabolic move is over. Just like in Bitcoin's past bull runs, you don't get backtests of support. You skip them. That's what gold's doing. Got lucky here one time, but we're just hitting resistances, consolidating, accumulating, breaking out again. There we are. 5,300's hit. It's a game of chicken. Dollar looking for a further move. What's up, 𝐂𝐴 Madi Vannon? Jay Peters, think it got you. Keep subscribing, guys. You're doing a great job. Hitting those likes, subscribes. Powell is speaking very soon. That POS Powell won't cut rates. Well, my friend, he did cut rates, right? They cut rates literally at the last FOMC. So it's an interesting argument to be made. I'm not sure where you're getting that info from. Will we will get cuts after he leaves? Well, we're going to get one cut after he leaves. The Fed has, you look at the dot plot, projects one cut this year, 125 BPS cut. Unless something changes. Won't be this is his. We only have 2 more FOMCs with Powell after this. This is a sad day when he's gone for me. What's up, Craig? Watching the FOMC? Appreciate you. Help you out. What's wrong, senior boy? What do you need help with? I doubt we can help you. Fib 4.236 is a common bigger extension. I can't say I've ever heard or seen someone use the 4.236. You almost never use beyond the 2, honestly, especially not with macro moves. In crypto and, of course, in like shitcoin past, we've seen wild extensions. We've probably seen like 10s. But in general, you don't see things move like this. This is truly parabolic when you are getting 2, 2.6, 3. Like, that's truly parabolic. That means that the upward move is, what is it? It's like the upward move is double the retracement or something. something along there. Basically, that the pullbacks are significantly smaller than the breakouts, and that is just a description. It is like what is fundamentally a parabolic move. You just don't get them a lot. Can't imagine anyone buying gold here. I think the problem, Steve, I don't want to buy gold here, but the problem is, where are people putting money? At this point, the dollar has signed up to lose reserve status over the next 5-10 years. Rotating out of gold, where are you putting it? The stock market's at all-time highs as well. Where are you putting it? Crypto's in the shitter. I think that's the big issue, is money seems limited in where it can go right now. And so the dollar, or not the dollar, gold is likely where people are going into these hot assets, silver, whatever. You're happy you've been in crypto for years? Me too. Otherwise you'd FOMO in metals. Dude, it's so true, Ed. I want to harp on that for a minute. As people in crypto, yeah, we've had a rough few years. I'll give it to you. But we have been training for this. We have seen this. So much of retail and newer traders, TradFi traders, don't have the experience in assets moving like this. They don't understand how maybe, let's say pairs might be important information. How gold-silver ratio might be important information. How gold to S&P might be important information. Because even in crypto, understanding those pairs, like Bitcoin pairs, is very difficult, and many people struggle with it for years. We are built for this. We got this. This is all like in our wheelhouse. Seeing things explode, recognizing euphoria and FOMO. We've done it. We're on the other side of it right now. Man, gold versus SPX is pretty wild. That's pretty wild. That's more ground. We're set up. We got the tools. Let's hope we can take advantage of it, and let's hope that can be to our best. Because I agree, I'd be FOMOing into. Trump is against guns, buy guns. Yeah, man. Guns are always a great investment. Said the same when gold was at 4K queuing all over the world for it. True. And this is, so Dave, what I was saying, I don't know if you're a regular here, but what I was saying is we are, crypto people, we are so used to this, meaning we watched Bitcoin go up, we watched other things go up, and people say, oh, that's the top, and like it wasn't the top, and people say this is the top, wasn't the top. Like, we have played this game where largely others have not. It's an interesting position to be in. 4K, I certainly was not calling for the top to be in. 5K, I said we have a reasonable shot at the top being in, or just reversal for maybe a quarter, half a year, whatever it is. If gold does not stop here at like 53, it's I keep saying it, a game of chicken. It's just going to keep going up until like bids are maxed. The more it goes up, it'll create a positive feedback loop. We've also seen this in crypto, where price goes up. Price going up attracts attention. People buying in because of that attention pushes price up, and it creates this exponential or parabolic loop. And that loop tends to break down, in my opinion, at like the peak of buying. Like as soon as buying hits a maximum and then starts at all to move down, that's like when it's over. That's why people end up buying tops. Can't even sell silver coins, shop buying it. That is something that I don't truly know the implications of. Love to hear your guys' ideas. I've heard some of your opinions on this, but like the liquidity of metals is largely different, and I will say way worse than Bitcoin for 99.9999% of people, because you can't get market. If you want to buy metal, if you want to go buy silver from a broker, you're going to be paying what, a 10% on top. You go to sell it, you're going to be selling under 10%. That is not liquidity. Bitcoin, you can always get market. There's no, you have to buy it up percents, down percents. Eventually people take profits around the same time and the knife drops. I through watching Bitcoin and crypto, I think it's honestly not, that makes sense logically, but I think it actually happens before then. I think the top comes in before people start taking profits. I think the top is made when the peak amount of new inflows hit. Like that number will keep going up. All-time highs will be broken and broken and broken. And as soon as that like crests at all-time high of buying, because I've seen this in Bitcoin, like that peak hype has always been the very top. That's what we've seen over and over again, except for this cycle. But it's weird because all-time highs, and especially in price discovery, seem to be marked by peak new investment, peak new inflows, not when those inflows start selling. Now you can say people behind the scenes are selling. Of course, the price went down. People have to sell. That has fundamentally. But there's something counterintuitive about it where it seems to be based on like how many new people are getting in, how much new hype there is. And then the panic selling comes later. All right, we got 10 minutes till 𝐶HPOW. 10 minutes. Fees. Ronald Grump, if you've never bought metals or sold metals, it is fees, but it's really just spread. That's how it's always been. Like if you take a pound of, pure, an ounce of pure silver to a shop, you're not going to get market price. It's not happening. You're going to pay, and you can say it's fee, but it really isn't. It's really spread. The spread and fee are the same thing at the end of the day, but it's weird. It's weird because only the paper market can you trade and not hit that. Spot market, always. It's interesting. There's always a spread. Yes. Thank you, Pickle. Our resident metals chat over here. Now, I know a lot of you are in metals. Are those glasses blue screen protect? Yeah, of course, baby. They're for your protection because these baby blues, they'll get you. What's up, Tom? The premiums make it prohibitive to trade silver. Yeah. And gold and metals. You have to make money just like a pawn shop. True. But so I guess, and I'll move on from this. The thought here is that other assets don't suffer this way in general. Other highly traded assets, or it's like assets people have FOMO'd over. There's been FOMO over. They don't tend to trade like that. It's not unique to metals, but it is definitely different than most of the crazes we've seen over the years, right? It's interesting. I don't know how that impacts it. That's what I'm saying. What's up, Hookah Fish? Good to see you, brother. Toss Beach, spread it. Can we look at Clash? I did get an alert on Clash last night. That's the only reason I'm going to bring it up. We're going to do it really quick, though, because I'm sure that's not what the audience is here for. Well, Clash did break out. Did move to 6.61 cents. Here's where we'll see how correct or incorrect I was. I did predict a move to a lower high here. On Solana, trade a little higher. Interesting. I'm glad you brought this to my attention. But we're not going to get into it deep here. Actually, what I'm going to do is just set another alert. That's spicy. That's spicy, though. I see George streaming like every other day. I see those pop up on my feed more than his morning live streams, which is funny. All right, 1,100 votes on the poll. We can do better than that, boys. Stop lurking, start clicking. It's playing. FOMC. So we don't know yet whether his speech will be hawkish or dovish or nothing burger. Nothing burger is always a good bet. Basically, will they talk about pauses? Will they talk about not inflation heating up or cooling? This is going to be basically what we're looking for here. So far, 41% nothing burger. I think that it's not a bad bet. I think, though, if I had to take hawkish or dovish, I'd probably take hawkish. We'll see. We will see. Stock markets are at all-time high. Metals are at all-time high. The dollar has been getting riggedy wrecked. It's probably hawkish time. Powell out of USA. That's crazy. Why would he's an American citizen? I would get him out of the USA. Benny Chan, a guy traded gold 2 weeks ago. Now he's up 500K. Oh yeah, I bet there are examples of that. I bet there also are examples of people being down 500K that just started trading metals 2 weeks ago, and probably more examples. Who clears third 17 times? Gina gone wrecked. I know the whole world's gone to shit since Gina left. Clash of Picks is going live tomorrow. I don't know what that is, Crypto John. Guys, a lot of people hate Powell, but look at he's the chair right now. Look at gold. The stock markets are at all-time high. Gold's at all-time highs. Crypto is crap in the bed. Silver's at all-time high. Like, I don't know. Things could be worse. Things could be worse. Yeah, it's here because of you. Love you, Ed. What's up, Crypto Steve-O? Get your seatbelts on. It's time. What is the market cap? What's the MC ask user? I don't know what you're talking about. Of what? Maybe I missed it. We are minutes away from the FOMC, from Powell speaking live right now. Who I think the next Fed chair is going to be, honestly, I have no idea. I don't have a clue. Could be anybody. I have no idea. I thought it was like people were pretty set on it being Besant or whatever recently. And then that seems to not have, I don't know, man. I think it's probably silly to just, it's silly to even try to guess at this point. We'll see closer to the date. Whoever Trump wants, that's how that works. Just whoever Trump wants. He gets to nominate them. If you're looking for someone to blame, dude, it's certainly not Powell. For whatever it is you think, it is what it is. Sure, Crown, I will nominate myself. Actually, you're right. Sailor, new Fed. That'd be weird. Trump, next Fed chair. Steve, optical art is not wrong. That is a possibility. Definitely a possibility. I don't know. Better in your hand, a Bitcoin or 16 ounce of gold begs the question. Rudy Poo, dude, you know, it really comes down to different people. I personally would go with the Bitcoin. That's me. And other people may choose the gold, and I totally understand that. A big thing I want to keep preaching for you guys, because it doesn't seem like this is true, but I want to keep preaching this, is that gold people, metals, bugs, and crypto people, we are the same. We are the same mindset. We are the same. We see the world similarly. It is they are both rejections of fiat. They are both rejections of centralized control. They are both rejections of the money printer. At our core, there is nothing more similar market-wise for metals and crypto and Bitcoin. Let's say Bitcoin. There's nothing more similar. There's not another asset that you could say gold and silver are more akin to something else. No. It's crypto and Bitcoin and metals. We used to be the same people, and we largely still are, even though it kind of feels like we're not for some reason. Just feels like we're not. I think it's Peter Schiff. Peter Schiff drove a division between us. When I started crypto, every single person who had Bitcoin had gold, had metals. I think they still do. I think that it's just become like kind of a ridiculed point. It's like, I don't know. There's like hate there. We don't got to do it. My teeth are so white. You're distracted by it. I don't know how, man. I don't know how. I don't even think I brushed my teeth this morning. Don't tell anyone. I don't think that either gold people or Bitcoin people support the Fed. I mean, we here on the channel, we enjoy watching the Fed. Without the Fed, here's how I also view it, is without the Fed, we would be just crushed. The U.S. would be crushed. Congress would literally just vote to blast money. We would already be in hyperinflation long ago. With that, like, the Fed is the brakes on government. The Fed, it acts as brakes. I think that's the best way to do it. If it was up to Congress, and it is up to Congress, and that's why we have runaway deficits, runaway inflation. They would just do it overnight. They would just it would be no question. There'd be no one to push back. It is so. If Congress is one thing, it's something that votes to print money to get themselves elected. That's like what they do. So while the concept of the Fed, I think, is bad, the concept of centralized fiat is bad, just simply removing the Fed does not answer that question. It does not fix anything. It makes it worse. That's my opinion. The whole thing needs to be overhauled. Everything needs to be redone in that sense to actually fix the problem. That's how I see it. What's up, Merlin? This guy gets it. I mean, I have good takes on some things. I wish I was always right. Got bad takes on some things. I mean, you guys think. I try my best, though. Pay for anything with Bitcoin directly, but if you still could, if all you had was Bitcoin, you could just live fine. Yeah, that's a question of payment processors, really. It's not really a question about Bitcoin. Has Bitcoin historically moved with gold? Hello, Bob Ali. It's a cool question, and we can see that answer simply by, let me refresh this. We can see that answer simply by looking at the gold Bitcoin chart, the Bitcoin gold chart. My instinct is to say, not really, because Bitcoin has moved up its entire existence. Gold has largely traded sideways, so they can't be that correlated. Gold is blasting now, and Bitcoin's not blasting now, so the correlation is likely weak. That's how I see it right now. Let me see if I pull this up quick. Do I have time? Might not have time. We're so close to Chairman Powell. Here we go. So Bitcoin versus gold, are they correlated? Not really. Not so much. Bitcoin has moved up in its life. Gold has moved really sideways a lot since 2010 until very recently. And then what happened when gold started trending up? Bitcoin was trending down. So there is like not a good correlation fit to me. Right now, they seem pretty inversely correlated. That's why people are talking about a rotation from metals to Bitcoin. It's largely hopium, but that's why is right now they're inversely correlated. So they're hoping that when metals chill, that crypto will move again. And it's not a bad bet. I just don't think that the reason is a rotation. I think it's elsewhere. Neither here nor there. We'll get into it, though. What's up, Antonio, Range Telecom? Welcome to all the new subscribers. Guys, there's still time. We have just seconds before Chairman Powell joins us. We are the home of the FOMC live stream. We invented it. I appreciate you being here. Welcome to all the new people. We cover all the FOMCs and typically anywhere Powell speaks. Join our crew, subscribe. We cover markets every day, and here we go. Here we are. Lock in. Not muted. Watch your speakers. I have no idea. Their volume usually sucks, but no audio yet. Some things around. There he is. Goated. There we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 3/4 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Gina first. Only Gina. No other questions. Just Gina.
Hi.
But you're not Gina. Please shut up.
Chris Rugaber at
sir.
Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the 𝐒𝐴𝐶 case, and Treasury Secretary Scott Bessent criticized that as political.
No
Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really 2 questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick.
Fine questions.
Nick Timros, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today on, I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to, this is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
They're asking questions about, like,
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all?
A question. The reason he might seem frustrated right now is they have not asked a single question that he should answer. They haven't asked anything about policy. It's just about
there's a time and place
suits.
for these questions, and
That's not right now.
but not something I'm going to be getting into today.
Not right
Thank
now.
you.
It's not the time or place.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. And another one that might, lead to similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
It's not even uncomfortable.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting, we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by one, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. You know, it's in the eye of the beholder, and of course no one knows with any precision. Is that, you had a follow-up?
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December,
no dot plot, no graph,
most
no
people
data.
had additional normalization.
Take a shot, data.
But
No
at the
data,
same
double
time,
shot.
we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, you know, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Got to let the data speak. You can't interrupt it.
Thank you, Chair Powell. Mara
Doesn't like
Moakley
that.
from Bloomberg News.
Chair Powell.
To what extent did the committee
This is a new
discuss the
person.
possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
Amen. A real question.
So there was broad support on the committee for holding today. Broad, I would say, including
Broad,
among
yeah,
non-voters.
probably all of
So
them.
that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance?
Mandate tension.
Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
That's a great way to stay in shape. This is not the most exciting.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted. And I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think that the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
These are the worst questions maybe ever.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do what we think is the right thing, but that's not where people's expectations are right now.
Gold might go to all-time high during this.
Victoria.
Victoria, what a great name.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
You know, over time, you've seen that U.S. rates have remained
crazy low.
They haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, you know, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But you know, right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that, you know, in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. You know, the thing is, I mean, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not, and it's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but, you know, it's much more, you know, assessments of the fiscal path and fiscal policies and risks and things like that that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So it's not, there's not a tight link between, you know, 10-year rates and the overnight rate.
Elizabeth.
Thanks so much, Elizabeth 𝐒𝐚𝐫𝐚 with ABC News. Republican Senator Thom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
Yeah, stop asking.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of
independence
is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, you know, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context, this is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, you know, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Thanks. Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the
gold
labor
all-time high right now
softened
during the FOMC. This is a first.
But you're right. Part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market.
You got all-time highs right now, baby.
So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, your strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time. Consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from, but the economy overall, growth is on a solid footing, it looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control and, frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time is rising productivity. So we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning. And it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Thank you, Chair Powell. Bai from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly precisely when this will happen, but there's an expectation that sometime in the middle quarters of the year we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we'll be able to see.
Richard, Escobedo.
Gold's still pumping all-time highs.
Thanks, Chair
FOMC,
Powell. I'm
that's a
Richard
first.
Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. You know, geopolitical risk for us is, a lot of it is around energy, oil. And so far we haven't, you know, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. You know, longer than that, it's trade, and, you know, the trade, the economy, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Yeah, that's where that is.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance.
Chair Powell, drink.
With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but you know, it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but you know, there's growth and there's how fast the potential is growing, and at a time of you know, high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. You know, GDP was negative in the first quarter last year, so the overall, over the year, the numbers were nothing like that. You know, it was more in the mid-twos for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So
I feel like it's not.
There has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
It's weird that the dollar is down and everything is up on no change.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Good luck, bitches. Deuces. Let's go.
Honestly, I'd say a couple of things. One is you know, stay out of elected politics. Don't get pulled into elected politics.
Amen.
Don't do it.
Amen.
And that's another thing. Well, another is that, you know, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at it, and I have worked hard at it. So
there's not very much.
And the last thing is, you know,
It's going to break out.
it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public
Anybody have
well-being
cadre on
than
their
work at the
on their
Fed.
bingo card? I did not.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves, and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the
All
last
right, you
question.
said gold and silver. Last question, Nicole. This has been very slow.
Hi, Nicole Goodkind, Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model. And we knew it from the very beginning. It was not in the model. A trade war of this scope, we've never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here, and like maybe happening now with AI, we're all over that. And everyone studies those periods, and we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not. No one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time.
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything, and so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what changed was what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
That's it.
We're done.
Okay.
We're done.
Thank you
That's
very
it.
much.
We're done. That's it. Gold all-time highs during Powell's speech. That's a first. I will admit to you guys, this was probably the most nothing burger of any FOMC in a while. It is what it is. I appreciate you guys tuning in either way. But no interest rate cut. That was what was expected. No curveball. Really no talk about quantitative easing or tightening. The majority of the questions, and this was the weird part, were directed towards non-fiscal topics. There was a lot of questions about the Fed investigations, the suits, all of which, of course, he didn't answer because that's what he does. They asked him about kind of the coming to end of chairmanship, which he talked a little bit about. There are two more FOMCs where Chairman Powell will be the Fed chair. So we have two more with him. His chairmanship ends in May, where he will be replaced. It was weird. Even on the interest rate decisions. So typically we see really volatile price action. I want to say 80+% of the time, we get something like this on Bitcoin, where price is trending into the decision. It'll reverse. Powell will speak. It'll reverse again. It basically just stops everyone out, right? Very, very unusual. Nothing happened on the interest rate decision, really. Nothing. Powell spoke, nothing. I mean, it traded lower both times on Bitcoin, but very slightly. Ended up where it was, as it usually does. But this is incredibly low volatility. If we go back to the last FOMC, obviously in December, where we got our rate cut, really all of them in Q4, we saw big explosive moves in price action on those minutes, in those minutes. This was very unusual. Perhaps it's a calmness heading into 2026. I don't know. Gold spectacularly hit all-time highs while Powell was speaking, which is interesting. With no cut, you would expect some strength in the dollar. Strength in the dollar. Well, you'd expect maybe not strength in gold and silver, but the opposite happened. Gold continued to blast higher as the nothing burger questions flew. It was an FOMC. We got a lot of votes in the poll. Most of us were right with nothing burger. We had a lot of new subscribers. What's up, Sanad? I see you subscribed recently. Make sure you join our Discord, discord.gg/TomCrown. Gold is still in price discovery. Where does it stop? Nobody knows. It has actually reached, I'll just reiterate this, the 2618 extension from the end of last year. Gold all the way up at 5,300 and still pushing. At this point, it's hard to look for anything but a blow off top. Not necessarily going to say right now is the top is going to go down or something, but as we are not really seeing back tests of previous resistance, we're not really seeing price return, we're seeing these big extensions hit. It's characteristic of blow off top movements where price just keeps accelerating until it collapses in on itself. I don't know. It's pretty crazy. Silver is a little muted. Saw some gains during the FOMC, but still below its all-time high, perhaps just waiting for gold to give it a moment. I still think silver's moving higher here, 122 obviously in sights. Metal's really stealing the show. $200 silver, definitely could happen. I am waiting to see at 122. 122 could be the first corrective move. Could be. 212 to 245, I think, is the obvious play. If we see this 100 zone cleared, obvious play. Silver could trade much higher. When we look at the silver to gold ratios, it is interesting. Gold to silver, silver to gold. that they have moved to a significant trend line. This pair. And exactly on this trend line is when we saw silver stop breaking all-time highs and gold continue on. Perhaps gold has some ground to make up against silver. I don't know. But it would suggest that. Or a break of this trend line and silver then maybe go on to paint that ripper to like 200. It's been a weird FOMC. Weird Sherpowing. But I'm glad we got to spend it together. That's all that matters. We'll be live again Friday, as we usually are. Hope you tune in then. Shout out to our sponsors, exchange sponsors in the video description below, FEMEX and BYDFi. Sign up with them using my link. And really, guys, I think that's about it. Trump's speech today, I didn't see it on the schedule, and that shocked me. He always speaks when Powell speaks, every time. He's like, oh, I better schedule something. I guess until next time, my friends, I will catch you soon, watching gold, watching silver, praying for Bitcoin.